Assalamu alaikum. This is Khadizatuz Zohara. Welcoming you all in my second class of risk and uncertainty. Today we are going to learn about the measurement of risk. Before measuring risk, we have to know what is risk-free return and risky return. Risk-free return, when actual return equals to the expected return, that is known as risk-free return. Returns from treasury bill, interest on fixed deposit receipt of bank, return from preferred stock, etc. are the examples of risk-free return. These securities provides with fixed income, so that these are called risk-free return. Risky return. The returns which carry risk are known as risky return. Return from the investment which is not fixed and where there is doubt of loss, that is called risky return. Returns from common stock investors are considered as risky return as that return is not fixed per year. Measurement of risk. Measurement of risk is essential for the success of any business organization. Successful measurement of risk helps in controlling risk, which indirectly helps in reducing the possibility of loss of business. There are different methods for calculating risk. Different methods are applied according to the requirement of and condition. The methods are standard deviation, probability distribution, and coefficient of variation. Standard deviation. Standard deviation is a statistical measure of the variability of a distribution around its mean, and it is the square root of the variance. It is a measure of how much an investment's return can vary from its average return. It is the measure of volatility and in turn risk. It is a statistical method of calculating risk. In this method, summation of square of deviation of past earned return from average return is divided by the number of years. After that, this result is expressed by doing square root. The greater the standard deviation of returns, the greater the variability of returns, and the greater the risk of the investment. Probability distribution. Probability distribution describes the occurrence of all possible outcomes of an event and the probability of occurrence of each outcome. It is worth nothing that the sum of probabilities of all possible outcomes must equal unity, because probabilities of all outcomes together must equal certainty. The concept of probability distribution is required for evaluating and comparing investment projects when managers have to take decisions under conditions of risk. The higher the probability distribution of expected future return, the smaller the risk of a given project, and the vice versa. Coefficient of variation. It is the ratio of standard deviation of a distribution to the average rate of return of that distribution, and it is the measure of relevant risk. Standard deviation is an absolute measure of dispersion, and it may give misleading results if the alternative assets differ in size of expected returns. In such a case, coefficient of variation may be used as a better measure of risk. Generally, the larger the coefficient of variation, the greater the risk, and the smaller value of coefficient of variation is acceptable. Hope you all will understand, and now there is a time of homework. I have given you 3 homework like previous class. Hope you all will do this and send it in my inbox. Thank you all.